Welcome. I'll be back. I'll be with you in just a second. I'm trying to connect to Facebook. Hope you had a great day today. It was a pretty good day in the market. So connecting now to Facebook. It'll take me just 1 second, and then we'll go ahead and get started. We should be live on Facebook. So welcome everybody. I'm Sami Abusad, Director of Education at T3 Live. Today's presentation is about why I don't trade spready stocks. But it's not just about spready stocks. I'm going to share with you some valuable information about the spread level 2 stuff that I hope you'll find very, very valuable and will help you tremendously in your trading and decision making going forward. Before we start, as always, a standard required disclaimer to let you know that trading is risky and that whatever we discuss today is for educational purposes only. Okay? So make sure you agree to that before proceeding with today's video. But if you find benefit in today's video, I would really appreciate it if you hit the like button. Why do I want you to hit the like button? Do you think I want to boost my own ego? No. It's because unfortunately, apparently the Google algos, when the video is liked, then they pick it up more. Otherwise, it stays buried in traffic. And so that's why. So if you find benefit, hit the like button. That would be great. And if you are interested in trading with me or checking out my services, check out the links in the description below. Okay? With that said, let's switch on to the slides and we're going to go ahead and get started. So I don't trade spready stocks unless I have to, unless the play is amazing, I can't pass it up, I got no choice but to do it. Okay, then I do it. But generally speaking, you're not going to see me trading the high flyers, the expensive stocks, the really spready stuff. You're not going to see me doing that. Now, before we get into the reasons as to why I don't do that, let's go over the basic stuff here. First, what is a bid? The bid, I know a lot of people know already what a bid is. The bid is the highest price a buyer is willing to pay for a stock at the current time, because the bid can change, right? It changes every second almost, every minute for sure. So the bid is the highest price the buyers are willing to pay. The ask is the lowest price sellers are willing to accept for a stock that they already own. Okay? We all know that. The ask is also called the offer, right? All the time. Now, the spread, the difference between the bid and the ask is called the spread. Okay? Or the bid-ask spread. It's the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. So if we were to look at a level 2 level 2 window, that would be the highest bid, the highest price that you see on the left side of the level 2 screen. Every level 2 is the same. I mean, this is E-Trade Pro, it's the same. This is Sterling, it's the same. They all look pretty much the same. So that's the bid. And it's also called the NBBO. The highest bid, the lowest offer is called the NBBO, the National Best Bid Best Offer, is what the NBBO stands for. Okay? So in this case, the highest bid was $25.99. The lowest offer was $26. Okay? Now, level 2 information is it gives you also other bids and offers. So it gives you the levels, the other bids below the highest bid. So the next bid below it is $25.98. Next bid below that is $25.97. And so most level 2s show you between 5 to 15, up to 15 levels below the current bid and the current offer. Now, the current offer was really strong on this stock, so we're not seeing any other offers below. I mean, you'd have to go all the way to above to 28.40 to see the next offer. So this stock, but we can look at a live level 2. It's just that right now it's after hours. Let's see if Apple, so here's Apple. It shows you 279.80, 279.68. So it shows you a few bids, a few offers. Okay. All right. So far, pretty easy stuff. They also give you the volume, they aggregate the volume at each bid, each offer. Okay, so you know how much volume, how much demand, how much supply there is at every bid, every offer. Okay, now of course, a lot of times, bids and offers can be, volume can be hidden. You can actually show a portion or not show any volume at all. In eTrade Pro, here it is. I can hide my entire, hidden stop. When I put a stop in the system, I can actually hide it completely. Hidden. It's a hidden stop. It's an option. In Sterling, right here for order quantity, I can be trading 1,000 shares and I can just show 100 if I want to. If I type 100 here, it'll only show 100. So sometimes you can hide it. But when the stock is a high momentum stock that's moving a lot, they can't hide them very well. Okay, this is why I like momentum stocks, because if they're moving, there's not going to be a lot of hidden bids and offers. Okay, they're not going to be, because when you hide your bid or offer, or when you hide your share size, you go to the end of the line. So if you're bidding for it at $25.99, you might have bid for it before this other person, but that other person, this other trader, is not hiding their share size, and they will get priority in terms of getting filled first. So when the stock is moving, people first don't have the time to be hiding their shares, but also you go all the way back to the end of the line, which means if the stock is moving up and you're trying to buy it, you're not going to get filled. So that's why I like momentum stocks, because they actually can't hide the bids and offers, not very much at least. Okay, all right. Level 1 data shows you this is what level 1 data is. It shows you the best bid, best offer, and here it is. That's level 1 data, $25.99, and it also shows you the volume at the NBBO, right? The volume, the aggregated volume, and it shows you the low of the day, high of the day, and total volume for the day. That's called level 1 data. Level 2 data, so level 1 data is provided by the Consolidated Tape Association. It's a company actually, to register brokers. They provide it almost for free. So in turn, brokers provide that information free of charge to most traders, non-professional traders. Okay, level 1 data. Level 2 data is provided by 3 exchanges, not the government. This is not the government. It's actually a real company incorporated, but it works in conjunction with the government, I guess. Whatever. So the level 1 data is almost free. Level 2 data is provided by the exchanges. There are 3 exchanges in the country: the NYSE, the New York Stock Exchange, the NASDAQ. New York Stock Exchange is by far the largest in the whole world. NASDAQ is number 2, and Chicago Board of Trade, CBOE. But they own 11 other exchanges, okay? Or 10 other exchanges. I think 10 other exchanges, because we have a total of 13 exchanges, such as BATS, EDGX, EDGA, ARCA. They own, I think, 10 or 11 other exchanges. I'm not sure really. And the level 2 data that they provide is historically was not free. You had to pay for it. But recently, when brokers went to zero commissions, everything became free almost. Because I'll tell you why in a minute. Why brokers are letting you trade for free. You think it doesn't cost them money for you to trade? Because they have to pay the exchanges. It does cost them money, of course. They have to pay the clearing firms. The broker and the clearing firm are usually 2 separate entities. So it does cost them money for you to trade with them. There is a cost. Why are they offering it for free? A lot of brokers, not every broker, but most brokers are. We'll talk about that in a minute. So level 1 data is technically all you need to be able to place a trade. And it works just fine if you're an investor. But if you're a day trader learning to read the depth of the level 2, it's called the depth of book, provided by the level 2 is critical. What's depth of book? Depth of book is the different levels below the highest bid and the lowest offer. So the different bids and the volume. That's the level 2 data. It's called also the depth or the depth of book. Okay? Provided by level 2 is crucial. The depth of book shows you all the bids and asks where volume has accumulated. If there's volume, it's going to show up. Okay? It shows you where pockets of supply and demand exist. More importantly, this is much more important, it shows you how liquid the stock is and how far. Let me take my webcam down so I don't block any of the text. More importantly, it shows you how liquid the stock is and how far the next bid or offer is from current price. It's important. I'll go over that in a minute as to why. This gives you an idea of what kind of execution you might get should you decide to exit the position. Because a lot of times, I'm going to show you here, I can get into, you can get the offer easily. I buy it here at 1070, right? Submit the order. In this case, because we're in the after hours, you'd have to go to extended hours and then buy it at 1070. But when you try to get out, where will you get filled? So you have to check the bid, the highest bid, check to see how much volume there is at the highest bid, and then look at the bid below it to see where the next bid is. Now this is a $10 stock that did 17 million shares, so it's pretty liquid. But if we're talking Apple or some other stock like this, let's say, and right now the problem is, we're in the after hours, level 2 is, well, let me just bring up, here it is, it's coming up, but let's just go to this. Let's say you buy it at 279.89 and you can get out at 269.60, but there's only 400 shares. Let's say you have 1,000 shares. Where's the next bid below that? In this case, because it's Apple, it's liquid, there's 100 shares at 279.60, and then there's more at 279.52. But if it's not a liquid stock, the next bid could be at 279.40, 30, 20, or at 278. Okay? I had Zebra today as a swing. The spread on it was $2. So like in this case, let's say, this was live and it's not the after hours, it was real time, real trading hours. And you were in it and you had 300 shares. Well, okay, you could probably get out at 216 with 100 shares. But where's the next bid below that? It's at 206. Are you okay with that? So that's what the level 2 shows you. It shows you where pockets of supply and demand exist, but more importantly, it shows you how liquid the issue and how far the next bid or ask is from the highest bid or ask. This gives you an idea of what kind of execution you might get should you decide to exit the position. So before I get into a play, I check the level 2 to make sure it's pretty liquid. If I'm playing long, I want to make sure there's lots of bids and and each bid is right below the next. The prices are very close to each other. The bids are very close to each other in price. They're not very sporadic, so to speak. In other words, it shows you how wild the stock is. Okay? Now, stocks that have a wide spread between the bid and the ask are called Spready stocks. Stocks that lack a deep level 2 are considered illiquid or jumpy. That's two completely different things. Some stocks are really spready because they're like Amazon. It's a $2,000 stock, $2,300. It's gonna be spready, but it's not gonna be jumpy. It is a little jumpy because it's very volatile, but usually you're gonna have multiple, or Tesla, you're gonna have multiple bids right below. But other stocks that are not as liquid, they're going to be spready and jumpy. And so that's what the level 2 shows you. And that's why before I get into a play, I sometimes, when I look at the level 2, I like to look at the level 2 for a minute or two. Okay? So stocks that lack a deep level 2 are considered illiquid or jumpy. The spreadiness and jumpiness of a stock is controlled by the market maker or the specialist. This is where the presentation gets interesting, by the way. It's gonna get more interesting in just a minute here, is controlled by the market maker. On NASDAQ, they're called market makers. Now, all the market makers have been replaced by machines, by computers. Okay? The specialists on the floor of the New York Stock Exchange still exist, but a lot of them are also now replaced by computers, but there are some specialists still around. So the spreadiness, they decide how spready the stock is. Okay? The more volatile and illiquid the stock is, the more spready and jumpy it will be. Okay? Now, how did the government, how did the SEC, whoever, how did the system come up with why was the spread invented? Because it compensates the market maker and the specialist for being the buyer and seller of last resort. So when the stock is exploding, let's say, and there were no sellers for Amazon, it could go to $10,000, $20,000, if there are absolutely no sellers. So in order to keep an orderly market, the market maker, if it's a 4-letter symbol, it means it's a NASDAQ stock. If it's 3 or less, it's usually a New York stock. Like Citibank would be listed on the New York Stock Exchange, Bank of America, right? But anything 4 letters or more, Apple, Comcast would be, 5 letters. Those would be most of them. Not all, this rule doesn't apply 100% of the time, but most of the time, they're going to be, if it's 4 letters or more, it's going to be listed. It's going to be on the NASDAQ stock exchange. So, in order to be the buyer and seller of last resort, which is what one of their primary tasks is, it's the primary task. The other primary task, there's only two things really that a market maker is tasked with. One is to be the buyer and seller of last resort, so that if the stock gets bad news and there's nobody willing to buy it, they have to buy it so that it doesn't go to zero. And the other thing is to manage the open, to match the buyers and the sellers. That's their job, is to match the buyers and the sellers and to be the buyer and seller of the last resort. And maybe third task would be to determine the price, the opening price. But these days it's determined by computers. So in order to compensate them for that risk that they're taking, there's that spread. So all day long they're on the bid and the ask at any given time, and they're collecting the spread. And they try to be position neutral, so they don't accumulate too much Netflix or long or short. So they try to be on the bid and the ask at any given time and collect the difference between the two all day, every day. So they're making a killing basically. They're making a killing most of the time. But now they've been replaced by machines basically. But they determine the spread and the volatility of the stock. Now, I'm sorry, not the volatility, but the jumpiness of the stock. Now, so why is something like USO has absolutely no spread, just 1 penny? Because there's millions of shares at each level. It's a very, very liquid stock. It's not a stock, it's an ETF. Whereas a stock that's much more volatile, that has less buyers, they're going to open up the spread on those. They're not going to have, the market maker is not going to be bidding for it at 214 with an offer at 215, 1 penny like this. They're going to bid for it at, let's say, 214, and then the offer is going to be at 220. They're going to open up the spread basically. So the spread is basically a function of how liquid and volatile the stock is. Always remember that. The more volatile, the more illiquid the stock is, the spreadier it's going to be. Now, to make things worse, we also have HFTs, high frequency trading systems, and high frequency trading firms exacerbate the volatility of a stock to their advantage. For years, brokers have sold their clients' order flow. Your orders, our orders, are getting sold to high frequency trading firms, which enable them to profit off of traders' orders. This in turn made stocks more jumpy and volatile. Now, why is that? Because they're all competing for your order flow. So what happens is, when you send an order, they all see it. Like the 50 high frequency trading firms out there, there's just a few of them that are really powerful, and there's the little guys also, they see your order and they all start competing for it, which makes the stock jump quickly. So HFTs have made stocks more liquid but more jumpy. So when they go from, this is low price, so it's not going to happen here, but let's just say we go back to Apple. When it goes from 284, 280.48 to the next level up, it doesn't go slowly. It jumps quickly because everybody's competing for your orders. Now, this is really beyond the scope of today's presentation, but this is how HFTs work for the most part. This is from Wikipedia. This is not from me. If you haven't read the book Flash Boys, I recommend reading it. He talks about it a lot. Michael Lewis is his name. Great, great book. The audiobook is also on YouTube for free. So your order is placed. Now the exchanges, the order doesn't arrive at all the exchanges at the same time, right? There's exchanges are located in different places. We as traders are located all over the world. So HFTs intercept your orders basically, okay? So they see that, let's say you send that order, you send it directly to the exchange, to whatever exchange you sent it to ARCA, or to BATS, and they see that that exchange doesn't have enough shares to fill you, and they intercept the order. They buy the rest of the shares that weren't filled by the first exchange. Now they buy it from you, right? If it's a market order, they're going to screw you on the fill. And they sell it over here they race you to the next exchange, exchange B. There's 13 exchanges in the country. They race you to the next exchange and sell it at a higher price than what they bought it for, what they paid for it. Does that make sense? So that's how it works. This is why nanoseconds are important. Milliseconds, whatever a fraction of a second is important for them. Because everybody's trying to compete. All the HFTs are competing for your order flow. This is precisely why we are able to trade for free these days, because the brokers are getting paid by the high frequency trading firms. Okay? That's what's going on. They're getting paid for your order flow, to sell you their order flow, okay? To make it visible. Which is why Interactive Brokers is not free, because they don't sell. I don't know if they do now, but they historically did not sell your order flow. Interactive Brokers, E-Trade did, Ameritrade did, Schwab did, all the other ones did. Okay, you got it. So that's what happens basically, and then you also have algos and bots that are making things much worse. So far, so good, I hope. I'm not trying to create any controversy. This is non-controversial stuff. It's out there. It's an open book now. Why is it an open book? Because everybody, you'd have to wonder why they're selling why commission is free all of a sudden. Because, of course, Robinhood came out, and Robinhood was created by two guys that built trading platforms for high-frequency trading firms on Wall Street. So Robinhood came out with free commissions, which and in a short period of time accumulated 6 million customers. And they were selling their order flow to the high-frequency trading firms and putting the retail brokers out of business. So the retail brokers were forced to go to commission free. That's what happened basically. So you can thank the two guys I don't know their names, the two guys that started Robinhood basically. But it's not good stuff, because they're basically working your order flow. They're screwing your orders. Okay, that's what's going on. But I want to go back to the presentation. So now, why I don't trade spready and jumpy stocks in general? Why? So I gave you all that information, and I haven't even discussed why I don't trade spready and jumpy stocks. Because it inhibits precise order execution. You can't enter and exit at the price that you want, especially exit. Like over here, I know what the entry is. I can get Apple right now at 284.46 probably. There's 100 shares here, with 200, a little more. I can always use a limit order. But once I'm in, if the stock is this is after hours, so stock is not moving very much. But during the day, it's gonna move. It might be moving fast. I might not be able to get out where I want to get out. Does that make sense? So spready and jumpy stocks obviously make it really hard to get in and out, but especially out of your stock at the price that you want. Okay? But it also prevents you from managing, controlling risk. If you don't know where you're going to get filled, guess what? You don't know what you're risking then. You don't know what your risk is, because you might not be able to get filled on the way out at a decent price. So it prevents you from managing and controlling your risk. Number 3, it exacerbates mistakes. You exit 1 or 2 seconds late, you sneeze, you look at your iPhone, you get a text message, and you end up exiting a couple seconds late, and your trade could be completely ruined. I was trading a stock that wasn't even spready just the other day, live on the microphone in the room. And I just looked at my text message. It was a text message from work. In just 1 second, took me like 1-2 seconds to look at the text message that I got on my phone. It cost me $658 just by being late just 1 second. Now, I was probably scalping something with a lot of size, but imagine if you're trading something that's really spready. Not being able to get this bid, let's say, whatever, you're trading Goop, which is not being able to get out right here at 13.17, your next exit might be at 13.13, 13.10. Does that make sense? So exiting 1 or 2 seconds late can completely ruin your trade. Accidentally, in your level 2, you're trying to get 1,000 shares, 100 shares. Instead of putting in 100 shares, accidentally doing 1,000 can kill your week. Can, just totally mess up your whole week. Entering 1,000 shares instead of 100 can ruin your week. And I'm not talking just 1,000. Could be also 10,000 instead of 1,000, right? Or 500 instead of 50. It's easy. My worst trade ever was on Triquint Semiconductor. It has got TQNT was the ticker symbol for it. It no longer exists. They got bought. Why? Why do you think it was my worst trade ever? It was like a $5 stock, super liquid, so no issues with the liquidity. Wasn't jumpy, but why do you think it was my worst trade ever? Because I had 10,000 shares in it. Okay? And I accidentally, when I tried to get out, I had 10,000 shares. It's hard. I mean, when the stock is moving fast, that's 10. Is that 10,000 or 100,000? That's 100. So I had 10,000 and I added another 0 by accident. So I was in it short or long? Short, 10,000 shares. And I covered it and I bought 100,000. Okay, and it filled me. It was very liquid. And the stock was dropping. And guess what? I bought 100,000 shares. Now I'm long 90,000. And it moved up a couple cents. I moved the stock a couple cents. That's it. And then from there, it started to drop. And of course, I didn't know what to do. So I said, okay, every time it drops a penny, I'm going to get out of 10,000 shares. When all said and done, I lost $15,000 on that trade. Okay. Now I learned from that trade that if you go to the settings in Sterling, you go to miscellaneous. This is the settings window. And you can specify the soft share limit. So if I try to exceed $20,000 per order, I will get a pop-up message by Sterling saying, are you sure? This is more than your soft share limit of 25,000 shares. So I went ahead and typed in a number, but this was blank. When I made that mistake, I was on Sterling, but it was blank. And so it cost me $15,000 to that mistake. Imagine, and that was not a spready stock. Imagine if you make a mistake like this with a spready stock. Just imagine, okay? And it cost me $15,000. Okay, true story. All right. Now, worst of all, not only does it inhibit precise order execution, not only can you not manage your risk, control your risk, not only are mistakes exacerbated in a big way, right? But worst of all, you are paying dearly for the spread and the jumpiness. You probably just don't know it. Let me give you a simple example. Let's say you average 5 trades per day at 1,000 shares each. You're not doing that much volume. You're doing basically 5 entries, 5 exits at 1,000 shares each. That's 10,000 shares a day. Okay? Let's say per year there's 253 trading days a year. That's 2.5 million shares a year for the whole year. If you traded every single day, we have 253 trading days a year. If you paid absolutely no slippage, no spread at all, you're trading USO. It has 1 cent, which is the minimum, the absolute minimum. 1 cent. Okay, 1 cent. In this case, it's 2 cents because it's in the after hours. But during the day, it's just 1 cent. You absolutely, basically, you're trading the absolute most liquid stocks. You're not getting, there's no spread beyond the minimum 1 penny spread. That, my friends, that spread that you're taking costs you $25,000 a year. Now, let's say on average, the stocks that you trade have 10 cents spread. That cost you, that spread, 2.5 million times 10 cents, that's $253,000 that you would need to make before you can even break even. Got it? This is money that you need to make before you can break even. It's mind-boggling, but people don't know it. The spread, just so you know, just so we're all on the same page. Wall Street people, I mean, no offense if you've worked on Wall Street. I have people in the room with me that have worked on Wall Street for 40 years and 30 years. I've had market makers in the room with me that know nothing about charts, that can't tell you whether the stock is going up or down, higher or lower, that are horrible at reading charts and being able to make money from reading charts. So what was I going to say? What I was going to say was, so they're not better, they're not any better than you and me at reading the charts and being able at trading. They're not better than you and me. What are they better than you and me at? How do they make money? The spread. It's Wall Street's hidden secret that it's an open secret nobody talks about. That's how they make money. It's on the spread. They don't make money. They don't know how. You think they know how to analyze charts like I do, like a lot of you do? No, they don't. Wall Street people are the worst imaginable at reading charts. What they're good at is at all the other stuff, at making money off the spread. If they have HFTs, if they have algos, that's what they're good at. Manipulation. This is why they have a bad name, honestly. So they're good at stealing, pretty much. They don't make money honestly, I don't think. But I'm not here to rail against the system. The system is what it is. I accept it because I can still make money from trading that system, no problem. But I just want you to be aware that that's how Wall Street makes most of their money. These days, a lot of it is probably HFTs, but historically always was based on the spread. If you read the 10K reports of some of the investment banks like Goldman Sachs, Morgan Stanley, in the past they used to list how many losing days they had, but now they don't list it. It's private information now. Goldman Sachs would have 1 losing day a year, or there was, I don't know which investment bank it was, Lehman Brothers or Bear Stearns. They're gone now, but one of them went for 4 years with only 1 losing day. In 4 years, how can they make money every single day, every single year? How can they do that? If they are taking risk, if they are taking on risk, if they're trading, really trading. No, they're not trading. They're just providing liquidity. They're manipulating stuff. They're collecting money based on the spread. That's how they make money. They don't make money by taking, like you and I, by taking risk and paying for it when we're wrong. When you're wrong, when you get a stock wrong, what happens? You lose. They don't lose. They never lose. What the hell? So why don't they lose? Because they are not actually taking risk. Again, feel free to read that book, Flash Boys by Michael Lewis. But again, I'm not trying to rail against the system. I'm just trying to explain to you what's going on here, okay? Okay, so let's continue. But we talked about how the spread makes it really hard to get good order execution, to manage risk, to exacerbates mistakes, how you have to pay for the spread dearly. We talked about all of that. But that's not all. We have not even considered slippage. Slippage is not the same as spread. Slippage happens when your order gets filled at a price different than expected. So let me show you. Let's say I'm in the stock, and when you're trying to get out of a stock, I don't fiddle with it and say, oh, let me get out here, 220, 280.3, 100 shares, limit order, whatever. I don't do that. By the time you finish typing in the order entry, the order information, it's gone. So what I do is I send a market order. I have a hotkey to send a market order. I may expect to get filled at 280.30, but guess what? Sometimes you don't get filled there. Somebody else front runs you, which is what the HFTs do basically all the time. You might get filled not at 280.30, you might get filled at 277 or 278 or 279, whatever. That's called slippage. Your order literally slips away. So slippage happens, so you might be okay with the spread. You might say, well, I see there's 24 cents spread. I'm okay with that. I'm going to get out at 280.20. I'm long Apple. I'm going to absorb that spread and get out at 280.20. But you might not get filled at 280.20 if you send a market order. Now, if you send a limit order, sure, you won't get the slippage, but the problem is you might never get filled. And if you don't get filled and the stock drops, you're going to have to chase it. So for exits, I use market orders. For entries, I use limit orders. So slippage happens when your order gets filled at a price different than what you expected. So spready, jumpy stocks lead to excruciating amount of slippage. Not only are you, the other things that we talked about, you're paying for the spread, you're also paying for the slippage. Slippage and the spread are two different things, as we discussed. Add the two up, and it's easy to see why a lot of traders lose money even when they are taking good trades. I see good trades all the time. I mean, what about DGX today? Didn't I say that's a really good gap to short? Didn't I say that? Tier 1 gap to short? Did I short it? No, I didn't. I shorted something else, just as good, but no spread, which was, what was it? It was the NAT. It's just as good, but no spread. So I went with the no spread, even though DGX was wonderful. Now, you can't catch more than one at the I can't usually catch more than one at the open, so I went with the NAT. Honestly, in this case, I could have caught both because the DGX triggered first and the NAT took a while to trigger, but I thought the NAT was going to trigger right away. So I just didn't pay attention to the DGX. So does that make sense? What I've been saying is spready stocks lead to excruciating amount of slippage. Slippage. Okay, so we talked about it. So even when you're taking good trades, sometimes you can lose money because you don't get the right fill. Okay. So this is. Hold on just a second. So one sec. Okay. We're going to talk about solution, but so just so you know, I did okay still, even without taking the DGX. This is what the NAT made today. That's $2,600. Notice what I traded? CNX. How liquid is that? Super liquid. Okay, no problem. I'm going to trade those all day, every day, whenever there's an opportunity. But I will not take something like the DGX unless I had to. If there was no NAT, there was no, nothing else at the open, then sure, I would have traded the DGX or the FFIV. FFIV was also almost a tier 1 novice gap, almost. That's a short. That's novice means, it's exhausted, so you want to fade it. So I would have played those for sure if I didn't have the NAT, but I had the NAT available to me, so no problem. I don't need to go trading the spready stocks. Okay? So I hope that makes sense. Okay, so we talked about that. Now, solution. I'm going to give you some possible solutions. Whenever possible, stay away from spready and jumpy stocks. Why do I say whenever possible? Because sometimes it's not possible. Sometimes you don't have another NAT. You don't have another CC, whatever, what was it? CNX. You don't have another CNX. All you have is DGX, and you absolutely love it and you feel sure about it. Okay, no problem. But in general, try to stay away from the spready and jumpy stocks. Trade stocks that are non-spready, that are also liquid. So not only are they non-spready, but they're really liquid, because sometimes I find stocks that are not spready at the moment, but they're not very liquid. So as soon as the stock starts moving, the spread opens up. Remember, we discussed the depth of the level 2. It's called depth of book or depth of market. The depth means it's, what are the different levels of bids below the highest bid and above the highest offer, the lowest offer. So if you don't get filled at the highest bid, where are you going to get filled? So what's the next level below it? So try to focus on non-spready and liquid stocks, and unfortunately stay away from the brand names or the name brands. Okay, stay away. Why? Because name brands are dominated by algos and HFTs. Unfortunately, they are. If you're a hedge fund manager and you're investing in some company that's called, who knows what it is, it's going to be a problem. You want to invest in the biggest companies, the most well-known companies, the most liquid companies. But most hedge funds now have algos running everything, running the show. Okay? Most hedge funds, most quantum funds, all they do, they don't have employees. They might have one employee checking computers, turning on computers, or making sure the computers are working right. I read that's like 7 years ago, I don't know, or something like this, long time ago, that the Goldman Sachs equity trading floor used to house 600 traders, actual traders, proprietary traders for Goldman Sachs. And that was like 7 years ago that I read this. At the time, they had only 4 left. 4 out of 600. So everything is run by machines now. And name brands, unfortunately, are just dominated by algos and HFTs. Algos and HFTs all make even the most liquid stocks jumpy and sometimes spready, but mostly jumpy. What does that mean? So when it goes from 215, you're trying to get it at 215, you see, 215, let me get it at 215. You press 215, it goes to 217. It slips out of your hand just like that. You're trying to get it at 215, it jumps because they're intercepting your orders. That's why. They're front running you all the time. Does that make sense? So it makes algos and HFTs and bots and all that stuff, they make stocks jumpy. So when they transition from one level, one price to the next, they go quickly. And so, again, you get bad fill. You get slippage. Always use limit orders for your entries. I always use limit orders for my entries. If I don't get filled, no problem. But on the way out, a big problem if I don't get filled and the stock is going against me. So I use either market orders or wide limit orders. Okay, so you can create hotkeys depending on what platform you use to exit with a wide limit rather than a market order. Why? Because the market order is telling the HFT, go ahead and rob me blind. It's a market order. Fill me at any price. Now, of course, they're supposed to follow the rules. They're supposed to fill you at the NBBO price, the National Best Bid Best Offer. Do they all follow the rules? Do they all follow the law? Absolutely, positively not. I'm going to tell you a true story, and I'm naming names here. It's Citadel. It's the biggest market maker on Wall Street. I used to trade with a firm called Legend Securities. It's no longer in business. Okay? That's a long time ago. 1,000% of the time, I'm going to turn on the webcam. 100% of the time, I traded with limit orders. I didn't even have speed keys or hotkeys for market orders, only limit orders. And what route did I use? I used Citadel because it was a free route. That's back in the day when we had to pay for commissions and for ECN fees. So market maker routes are usually free because the market makers are providing these routes to the brokers for free because they're trying to snoop on your orders. They're trying to, work your order, basically. So I 100% of the time use limit orders for my entries, exits, stops, everything. So Citadel calls my broker and says, we can't have your guy doing limit orders. If he continues to do limit orders, and I've always been a high volume trader, always have been. I do a lot of volume. So if he continues to use limit orders, we're going to pull the route. So my broker tells me, if you don't use market orders, I'm going to I'm going to remove the route. What's the route? Let me just show you what the route is, what it means. These are the routes. ITGI is a market maker. ARC is a route. These are also exchanges. So some exchanges have their own routes. Those are routes. Those are called routes. Okay. In E-Trade Pro, they probably don't give you very many routes. They call them smart routes because it's smart not for you, it's for them, right? They give you ARCA or IEX. And they give you a couple routes or exchanges, and then auto, that basically says fill me at the best route possible. Usually it's a market maker on the other side of your trade. Okay, but at any rate, so those are the routes. So Citadel called my broker and said he needs to, we're getting all these limit orders. He needs to switch to market orders, otherwise we're pulling the route. Now this route was being used by 2,300 other traders. At the firm where I was trading, there were 2,300 traders. I wasn't the only one. I was one of the most active, and so they singled me out. So the broker called me and said, I know this is your favorite route, but you have to use market orders. So immediately I said, I'm calling the SEC. I'm filing a complaint. Because they're saying what they were saying basically without saying it. We want, with limit orders, we're not able to manipulate your fill. With market orders, we can manipulate it. Does that make sense? Because why should it matter to them? They're supposed to fill me at the NBBO, National Best Bid, Best Offer, using limit or market orders. Doesn't matter. So why did they want me to use market orders? You tell me. Why? Because they want to make money off of my orders. When I use a limit order, I'm telling them what the worst price possible that I'm willing to accept. They didn't want that. That wasn't good enough for them. I usually give 3 cents on the way in. Meaning, so if I buy the stock here at 216, I'm giving it all the way to 219 to get filled. 3 cents above the offer. When I'm getting out, I'm giving it 10 cents if I'm using a limit order. That wasn't good enough for them. They wanted me to use market orders. So I said, okay, that's clearly illegal. Let me go ahead and file a complaint. That's what I said to myself. But then I said, because I was really, upset. But then I said, if I do that, then I lose the route automatically. And it was one of the few really good routes that were free. When I say a good route, I mean it was liquid. Some routes, some of those smart routes or market maker routes, they're not very liquid. The market maker isn't Citadel. Is not a big market maker. Okay? So they might provide you, the broker, with a route, but there's... but you try to get out, they don't fill you. They don't have to fill you if you're sending it to a market maker as opposed to the exchange. And so that's a true story that happened with me and Citadel. All right. And again, I was gonna do something about it, but I said, what's in it for me? If I do something about it, I'm automatically, and they figure out it's me, then I'm automatically gonna lose the route. And so I ended up not doing anything about it. But that's exactly what happened. True story. You couldn't make this stuff up. All right? Okay, everybody. I do have to go. So I hope you enjoyed today's presentation. I trust it's pretty much nothing like you've ever heard or seen. And I trust it was educational. And if it was, be sure to hit the like button. And if you have any questions for me, just reach out, send an email to info@t3live.com. They can forward it to me, info@t3live.com. Also, if you want to trade with me, feel free to go to t3live.com/day. You can get in for $49 for the first month. So you try out the room, try out the service, see what I do. And then if you're a swing trader, I also have a different service called the Strategic Swing Trader, where I share with you my swing plays and earnings trades. So go to t3live.com/swing. Again, $49 just to try it out for the first 30 days. You can't go wrong with that at all. Any questions, info@t3live.com. Again, hope you enjoyed today's presentation, and I will talk to you all later. Take care, everybody. Ciao.